Welcome to the latest episode of The Bridge by iCapital. I'm Sonali Basak. I am the Chief Investment Strategist at iCapital, and today I am joined by Insight Partners' Deven Parekh. He was an early member of the firm that is now more than 3 decades old and behind a lot of the big names in venture capital that you might hear about this year, like Anthropic, like Databricks, like OpenAI. Deven, what a great time to talk to you because this is a pretty historic year.
Sonali, thank you for having me.
All those companies that I named might go public in the next 12 months. And so when you think about what a big moment this is for the market, we have never seen an IPO market of that size before. How do you think about it from where you sit?
Well, look, I was meeting with investors this week and last week, and I've told them that so far I've been wrong 4 of the last 4 years in my IPO predictions, because I kind of came into every year feeling like, okay, this is the year where the IPO market is going to finally come back. And it hasn't really happened in the last 4 years. We've gotten some companies public, and there's been some activity, but I don't think anything relative to what people were expecting. And of course, now you've got these, we'll see what the timing ends up being, but you've got 3 or 4 of these large companies happening at the same time. And the interesting thing about that, and it's hard to know exactly how it'll play out, but I think what a lot of companies are worried about that are not those 4 companies is what does it mean for them? There's a lot of growth capital in the public market sitting on the sidelines waiting for these deals. And does it suck up all that capital? Does it make harder for that teeter down, which are some really interesting companies that are teeter down from these companies? Are they able to get out this year or not? And I think a lot of people are saying, okay, let's steer clear. Let's have some of these companies come out and then kind of see how they do in the markets.
Basically get in line.
Yeah, get in line. But I do think that there is a lot of anticipation, obviously, about these names. But I think the good news and the better news for the long term is there's a long list of companies that are not the 3 or 4 that you're talking about that also have great profiles. I think we've gotten spoiled with some of these AI companies because you're seeing growth that we've never seen before. But there's a lot of other businesses out there that are really interesting across a lot of different subsectors of tech, both consumer and enterprise. That are going to be fast behind. Now, whether that's a quarter behind or 3 quarters behind, I think it's hard to predict right now.
So what's crazy to me is if you think about even just 3 of those IPOs, it would be between $150 billion to $200 billion worth of dollars raised. Is there enough money in the market to support all those IPOs?
Well, keep in mind that also what's going to end up happening for some of these businesses. Take SpaceX. NASDAQ has moved the rules around so that it's going to be in the index pretty quickly.
Right.
So there's going to be demand, just given what the market cap of these companies are, and they're going to move into indexes pretty quickly. So that's going to soak up kind of a lot of demand for those names. What we don't know is obviously a lot of these companies have been private, not so much Anthropic and OpenAI, but SpaceX and Databricks and others have been private for a really long time. So you do have a big cap table of investors, some of who have gotten liquidity pre the IPO, but many have not. And so you're also going to see unprecedented amounts of things come up out of lockup, in 6 or 9 months. And how does the market kind of absorb that? And we don't really have precedents at that scale. But I think my instinct is there's so much interest in those assets that the market will figure out a way to kind of absorb those sizes. But Aramco was... People used to talk about Aramco as this amazingly big deal, and it's tiny compared to what we're seeing right now.
Well, what's wild, too, is that a lot of these companies have just raised money, actually. Pretty historic fundraisers that we've seen. And a lot of those new investor bases are 2-3 dozen investors into later stage rounds. How do you think about that dynamic, that so many investors are able to get in before the IPO these days?
Well, let's separate out a couple of things. I mean, one, yes, these companies are raising lots of capital, but at the same time, they have kind of they're consuming capital, at rates that kind of we've never seen before, right? And so it's not like it was optional for them to raise that money. They need to raise that money, and you can see it with Anthropic is probably growing even faster than they thought, and they're probably running short of compute and announcing new deals with Amazon just this week. So. The fact of the matter is that these companies had to raise the money, and there was enough demand from investors, not just venture investors, but I think when you look at kind of the universe of companies, universe of investors in those companies, everything from sovereign wealth funds to wealth management firms putting it through their retail channel. So these have ended up on lots of different platforms, way beyond just your traditional venture and growth funds.
Well, what's interesting, you and I were talking before we started taping about the dynamic we're seeing in the wealth market in particular, where there's a lot of wealth managers that want the special sauce. They want to get in early. They want to lean on people like us to say, where are the new Anthropics? Where are the new Databrickses? Where are the next phase of AI companies that are growing going to be? But then there's a ton of people who say, give me some SpaceX, give me some Anthropic. And it's hard to not say to them, well, why don't you want to get in earlier? Why are you waiting so long? You can understand why it's so excited to get into these IPOs. I'm curious how often you get into that conversation with people, that you have to say, some of these companies have already seen the best they're going to see in venture, and you've got to look over here instead.
Well, look, our strategy, is really one of investing everything from early stage to late stage. But if you look at where our dollars are, they're disproportionately on the earlier kind of side of the spectrum, not primarily in kind of the pre-IPO type category. And our investors are primarily institutional investors, but we have private wealth that comes into our funds as well. And I think you got two different types of investors. You've got investors who kind of want a diversified portfolio. They know that there's going to be Databricks within a portfolio, but there's also going to be ones that don't look as good as Databricks. And then you have investors who are struck by these companies that have just sparked an imagination in a way that, when you've got somebody talking about going to Mars, and you've got companies that are adding more revenue in a single month than the enterprise software industry does in a year, those are special names. And so I'm not surprised that people want exposure to those names. But I think what most financial advisors and wealth advisors would tell people is you don't ever want to concentrate your portfolio in a single name or in kind of two or three names. You want to have a diversified portfolio. So I think what we're trying to do, if you look at where we've had the most success in our own strategy, is what we call double down, which is we invest on the earlier side. We write a more modest check earlier in the company's life, and then double down in the winners, right?
How important is that diversification? We were looking at the data where, 6% of venture bets account for 60% of the returns. Yeah. So you really have to go hunting for unicorns, don't you?
Yeah, I mean, look, that is a venture strategy, right? The reality is people talk about power law only in the context of venture, but power law exists if you actually go look at the returns. Power law exists in buyouts, and power law exists in growth equity. The outlier power law multiple is lower, right? So in venture, the outlier might be 100x or 50x.
Which means dispersion among managers is much larger than every other asset class.
Well, look, I think we're at a particularly interesting time right now, right? Where there are certainly funds out there with a much more concentrated strategy. And they're going to look great if the AI boom continues. And by the way, they should. They were willing to take a concentrated strategy. I think, what we've basically said is, this market's changing at an incredibly fast rate. Innovation's happening at an incredibly fast rate. It's hard to assess these business models in real time because the changes are happening so quickly. But we believe in the innovation, but we're saying, look, we're going to say, let's take a more diversified set of bets and then go try to concentrate in the winners, in what we perceive to be in the winners in our portfolio, right? And I think either strategy, really, which strategy is going to look better is going to depend a little bit on what happens, in the market. And there's certainly a version of the world where a very concentrated strategy where you invested in 5 late-stage AI companies could look great.
It's interesting because the earlier stages, one thing we were talking about as well is this idea that the later you get, it's not just that the companies are bigger and the growth rates are slower. It's actually also that the premiums could be much higher that you have to pay. So for example, there was this great pitch book analysis that said companies that were in earlier stages in AI versus non-AI were much less, say 40% of a premium for AI companies versus 250% in those later stages.
But what I'd say, Sonali, if we were having this conversation 6 months or a year, I think we won't be talking about AI and non-AI.
Okay,
because
everything's AI?
But when I say everything is AI, it means if you're a software company today, AI is not part of your solution. You're not where you're going to have to be. Now, there are other categories. I'm not talking about saying, but even biotechnology, right? Like, even if you look at categories, if you look at a biotech fund today, a lot of what they're investing in is at the intersection of AI in biology, next generation drug discovery, right? If you look at robotics, there's a huge software component to those things, an AI component to those things. So I think this, over time, this AI, non-AI thing is really not going to be that much of a thing. Everything's going to have an AI.
Do companies come to you without an AI strategy at all anymore?
It's rare in the earlier stages. Sure, there are companies, a legacy software company has not yet done their repositioning. And by the way, we think that could be an interesting strategy, right? Like you have a company that's got deep vertical expertise, maybe in a smaller market. So it's not a market that Claude or OpenAI is going to say, I got to go get that market. They've got deep customer relationships. They've got data moats. They've got integrations to back-end systems. But they haven't yet really kind of figured out what that AI strategy is. We can help them with that, right? So that is a potential investment strategy as well. But I think it's unlikely that any of us are going through our portfolios in a year saying, oh, yeah, that company doesn't really have anything involved with AI. I think what you're more likely seeing in these big premiums is these, in today's world, these kind of next-gen AI native companies have had growth rates that we haven't seen before.
I want you to get us into kind of the next generation of companies. But before that, I want to talk about Databricks for just a second, because for me at least, it was the poster child throughout the course of the end of last year into this year of what people were talking about around software. It's like, well, wait a minute. Not all software is bad. This is like the holy grail of where AI-enabled software is really hitting on what this AI-driven economy needs: data. Right? How many people recognize that? How many people around you, I'm sure, in your immediate world, people are understanding the difference between the types of software. But do you think the market writ large, given what we've seen and the fear around software the last couple of years, I guess now brewing, it's really exploded?
But it's really in the last 6 months where you've seen this kind of, and look, I think what the market is basically saying is, if you think about how do you value a software company? You basically say, well, I'm going to take 5 years of discounted cash flows or 10 years of discounted cash flows, and then I'm going to look at the terminal value. And I'm going to take a terminal multiple, and that's what I'm going to do. Well, at a point in time when you believe that the company had really high gross retention and really high gross margins, you say, well, that's almost like a utility cash flow, so I'm going to give it a really high multiple. And now you're sitting there, somebody saying, okay, I'm not so worried about how Salesforce or whoever it is going to do over the next 12 months because they're probably fine. But when I go look at that terminal multiple, I'm not sure I'm going to give it as big a multiple because all of a sudden, maybe the retention, the moat is not what it was, right? And so they've reduced that multiple, and that obviously has a big impact, right? But I think what we're going to find, at least this is our view, is that over time, you're going to have winners and losers, like you do anytime there's technological shifts and disruptions. But it's going to require, this is also a time of execution, right? And execution also matters. We always just talk about technology, but execution matters. So the companies that basically take that historical moat that they have and then figure out, how do I take that moat and extend it? How do I add AI to it? How do I have the distribution advantage if I'm that incumbent. Mm-hmm. How do I not lose it, right?
Yeah.
Because we're this weird time where the cost of a disruptor is very low in being wrong, and the cost of an incumbent is really big in being wrong, right?
And incumbents aren't historically the best innovators.
Right, but I think that you're seeing in this case, you're seeing examples of companies that are moving and that are moving quickly. You're probably seeing examples of companies that are not moving as quickly. And you also have examples of things like, take a horizontal application, which does not have any kind of particular industry vertical specialization. Maybe it has no integrations into any back-end systems. Well, that's an easier disruption for a next-gen AI company than somebody who's like deep in kind of a vertical market, has all the workflows, has integration. Now, I don't think it's enough. I don't think that company can say, oh, I have all this, therefore I don't need to do anything. One of the things we're doing in all of our kind of buyouts, kind of our later stage buyouts, and I think this gives us a little bit of a unique advantage, having early stage and late stage, is our early stage AI team is working with our buyouts on how do we create embedded AI startups in these businesses. And the reality is, well, we have we have thousands of customers in these companies.
So what does that look like?
It looks like going in. I think if you think about my partner Jeff Horing's been talking about this for years, and now I think a lot of other people are talking about it. But if you think about the way you historically thought about software from a competition standpoint, is new company comes in and says, well, my software is better, my software is cheaper, whatever it is. But if you're paying $100,000, I'll sell it to you for 80, or I'll sell it to you for 120,000, but I'll give you more seats. I think in an AI world, you're basically going in and saying, I'm not going to go after the software spend, I'm going after the labor spend. And I'm going to sell you an outcome, right? And you have X number of people doing this task. You don't need as many people doing this task. I'm going to sell you that as an outcome. And maybe I'm going to sell it to you as a managed service using my technology, right? So if you're an incumbent and you have those customer relationships and you have the technology and you have some confidence in you, you need to have good net promoter score. People have to believe that you can do that. Well, you have a better ability to execute on that, assuming you have the right execution. And I think the challenge for a lot of private equity businesses are probably going to be, if you look at the historical background of a CEO of a private equity-owned firm, they came through sales and they came through finance, and now we're in this very product-oriented world, right?
It's funny. What you're speaking to is what I've always imagined in my head over the next 2 years to be a bit of a shakeout. Right? The reason I brought up Databricks was to just make the point also that a lot of the greatest software companies of the future, things that are more aligned with infrastructure software rather than application software perhaps, are in private markets actually. Yep. And so if you want access to them, that's the only real way to do
you've got a whole next generation of those type of infrastructure companies, Databricks being one, there's others as well, where they are accelerating because of AI. Right, because what's the fuel for AI, or the oil for AI? It's data, right? And so it's more important to have that data, in a single place, and an ability to be able to use that data really efficiently. And Ali's an unbelievable CEO and has executed really well, and has kind of gone from technology. He's kind of done technology shift to technology shift. Has done some really smart acquisitions. Execution matters, right?
Yeah.
But yeah, absolutely, there are private software companies that are benefiting from the trends in AI.
Do you ever worry, though, that people might miss it because they're so worried about what software might be in the middle of all of this AI disruption?
Yeah, I think the baby is getting thrown out with the bathwater.
Totally.
Right.
Yeah.
I think people are bragging about how little software exposure they have all of a sudden, right? From 6 months ago, people were bragging about how much software exposure they had. 6 months later, they're bragging about how little software exposure they have. And look, these things always over-rotate, and I think maybe there was a little too much excitement about software for a period of time, and now I think the pendulum has swung the other way. And I think there's still going to be just so much innovation going on.
So around the corner, what really gets you jazzed around the next generation of AI-enabled companies? Where is the puck headed?
Look, I think that there are lots. So let's start with what is everybody? What should everybody be worried about? What are people worried about? What do we spend our time thinking about when we're looking at these new deals? Look, Anthropic, OpenAI, these are pretty innovative companies. Anthropic is launching lots of new products every week. There's a risk of them continuing to move up the stack. What
do you mean by that?
So, right now you think about Anthropic as or people describe them as just a foundation model, right? And that they're effectively just going to be an arms dealer, and then all these applications are going to use that intelligence and build smart applications. But you're seeing in legal and financial services and other things that they're trying to offer some of that functionality themselves. Now, today is, and I'm using examples of companies we're not investors in, but, you've got Harvey and Legora who are deep in a vertical, right? But I think as an investor, you have to look at okay, how much value am I adding on top of the model, right? That's number one. But the problem with that answer is that's how much value you're adding today. That doesn't take into account where the model might go. That doesn't take into account how it might get trained in the future. And so I think one of the hardest things right now is kind of evaluating what is that moat and how durable is that moat, right? That being said, logically, the Anthropics and the OpenAIs are going to spend their time on very large markets, as they should. And there's lots of other markets out there where I think you can offer interesting solutions. And the other thing I think is much less likely is what I talked about earlier, offering these types of solutions as a service, using your technology. I'll take Palantir as an example of an early example of that, but offering it a little bit more of a service. That's less likely for somebody like an Anthropic or OpenAI to compete against, right? So I think you just have to. These models are getting better and better by the day, and I think what you want to look for is what are applications whose value to the end user customer gets better as the models get better, right? You don't want to be rooting for the models to not get better. You want to be rooting for the models to get better. And if the model gets better and better, and you actually are still able to provide more value to your customer, that's probably a pretty good place to be.
It's funny. We talk about this all the time from where we sit because it could help us with our research, but it's incomplete. It could help us with our video, but it's incomplete. And it does need to be better, actually, until we can get, an AI employee sitting next to us.
And I think most people would agree it's an incredibly powerful tool.
Yes.
But it doesn't get you to the end. It still does hallucinate. And so, there's a lot of these applications. Like if you're doing financial consolidation and you're reporting your public numbers, you need an audit trail. You need data governance. You need things that you're not just going to throw a spreadsheet into a model and say, send me the result.
Okay,
right?
so give us a peek then into the next market that you think might be really interesting.
Well, that's a really, really hard question because I think the pace at which things are changing, it's so hard. But for example, I think a lot of people have been talking about. I'll answer the question a slightly different way. A lot of people have been talking about cyber being. All these cyber stocks went down, with Claude.
That was pretty curious.
I think cyber's got a long way to run as an industry, right?
Wouldn't you think? I thought that was counterintuitive, right? Because on one hand, if you're worried about AI, don't you get more worried about cyber too?
Yes, because why we can debate why Anthropic didn't release Mythos, whether it was because they had to or because they couldn't or whatever but the risks that were being discussed were cyber risks, right? And I don't believe that companies are going to say that I'm just going to rely on one model company or two model companies to both assess the threats, fix the threats, remediate the threats, and continue to monitor the threats. That's probably not the way the market's going to end up going. So I think that when you have this unbelievable technology that's innovating that can be used both in really positive ways, but it can also be used in really negative ways, I think you're going to have more budget that's going to get needed to spend to make sure you defend against threats.
Well, even from where I think about this a lot is what happens when agents start to work together more in terms of paying each other online.
Yes.
When we start to envision a world where money is agentic, you need cyber defense to that too. And all of a sudden it's our dollars that we're talking about.
And also keep in mind, we talk about the world as if the only models that are going to exist are kind of OpenAI and Anthropic, but there are open source models that are being built that are pretty competitive, and we should assume that'll continue to happen. And if we ever end up with regulation or global regulation, which to me is a big if, but if we did, they may or may not fall within that, right? So I think cyber as an example is there'll be both new innovation, but existing vendors, are going to continue to do well there.
So I want to talk a little bit about the history of technological cycles for a minute, because if we were sitting here having this conversation last year, people kept asking, are we in a bubble? Are we in a bubble? Now you could ask, did some of the bubble pop actually a little bit, right? Are we still worried about a bubble when we've seen, a lot of rebound, but a lot of shakiness in the last 6 months over the AI theme? How does this cycle compare to other cycles you've seen?
I think it depends on your frame, right? If you're worried about valuation, then people compare it to 2000. If you're worried about, what can happen to the macro economy because of geopolitical risk, then people compare it to 2008. And people are worried about interest rates, well, then you compare it to 1994. So I think there's a little bit of a tendency to compare it to the thing that you're most kind of concerned about and kind of worried about. But you had periods. You definitely had these periods of time where you had, say, transitions from license to cloud, right? And then you had transitions from cloud to mobile. Like, people forget that Facebook went public, stock went down almost instantly because they didn't have a mobile strategy, right? And they had to go create one and buy Instagram, and it ended up okay. I think that what you have here, I mean, the period of time is a technological shift, like we've had those before, mainframe. It's just happening at a pace that those didn't happen at. It's happening way faster. So the time to adjust and make the changes in your business. So I think it's going to be the companies that are really who's able to retool really quickly in this new world. And I think the thing that's hard, and it's hard for everybody, I think it's hard for investors, it's hard for CEOs, it's hard for people within these companies, is that you don't have time. You don't have a lot of time because the innovation is happening at warp speed. And so I think it compares to a lot of those technological shifts that we've kind of talked about, more compressed though. To the bubble question, again, I think it depends on, I think if you wake up in the morning, you think of yourself as a SaaS investor, a SaaS public market investor, I don't think you think it's a bubble, right? Because valuations have compressed to like a 10-year low on a revenue multiple basis. I think if you're an AI investor, and I said these things are coming together, but I'm just kind of talking about in the context of a bubble. If you're a late-stage AI investor, I think you still think valuations are pretty high.
That's the biggest question. Are we going to look at these IPOs and say, "Whoa, everything was way too overvalued in the private market"?
But just remember that, like, it's amazing how quickly we forget things, right? Because like 2021 valuations were really high, and public markets were 20 times revenue. 20 times revenue. Were software multiples were. They're now like 4.5 or 5 times revenue, right? Crazy. But I think the thing we have this line we use internally: we don't overpay. Companies just miss their numbers. I mean, it's a funny thing that we say, but what does it really mean? What it means is that when we're underwriting a company, we're underwriting to a growth rate, right? And if the company hits their growth rate, we generally didn't overpay. It's when the companies don't hit their growth rate. And so let's use a positive example. I don't think anybody who wrote the check at Anthropic at $380 billion thought that that would be effectively a 12 times revenue multiple within 4 months, right? So that's a case of a company that massively beat its number, and all of a sudden the valuation didn't seem so expensive.
Yeah,
right?
NVIDIA has been going through this for years now.
So I think the question, I don't have the answer. Are all these companies going to be able to hit the projections that they're putting out there, right? And that's not a knowable. Because so many things are changing, and the markets are changing, the competitive landscape's changing, really, really quickly. NVIDIA is going to have new competition, right? So I think it's hard to say, but I think it tends to be that what happens in you got these areas of interest, people start putting capital as areas of interest, prices get bid up, not only because of competition, but because those areas of interest have very, very high growth. Yeah. And then the question is, how sustainable they are.
Well, that's the revenue growth rate, right? One thing that I think a lot of investors, I wonder if anyone's going to start to care, right? That the bottom line is actually quite challenged to the point you were making before, that they need to keep spending money. And most of the sell side believes that hyperscaler spend is going to start to taper off. I think I have a hard time wrapping my head around that because money is still needed to come in to finance this AI boom. So how is that spend going to taper off, actually?
Yeah, look, it doesn't. You don't see obvious reasons why that's going to taper off in the near term,
right?
Right, you don't. I think the things that you hear about in the market, obviously, these companies, both Anthropic and OpenAI, have made very big compute commitments, and that's what people love talking about. But at the end of the day, it depends on the week, right? There are weeks where people are like, oh, OpenAI make great decisions because look, Claude's now constrained on compute, right? And other times where it's like, oh well, they stopped doing video because they're so. I think these things change really quickly. But the truth of the matter is, you still have a tremendous amount of growth, and the other bottlenecks that we talk about compute, but energy is a bottleneck, getting chips is a bottleneck,
right?
All this stuff is a bottleneck.
Helium.
Yeah, because you have a lot of bottlenecks that can kind of. So I think right now there's not any obvious thing that you see that would slow the rise of demand. However, and this is the thing that it's just hard to know, is what you talked about. You talked about bottom line, and you talked about, look, there's a lot of these companies whose gross margins don't look anything like the gross margins you would need to end up having a really profitable business, right? And you could paint the picture. On one hand, you could paint the picture that these compute costs are going to go down. You can have economies of scale, and you can see gross margins expand. You could see another argument that says, right, and you got open source models that are there that are free, and the pricing comes down a lot.
Yeah.
It's amazing if you look at the penultimate model of what people charge for, not the most recent model, the last model, the per token cost is so much lower than the current model. And I think over time, what are enterprises going to do? They're going to say, well, over here I have a physics simulation that I'm doing, and I need the most recent model. And over here I'm running an HR application. I could take 3 models ago, and it's good enough. And they're going to start optimizing that token spend, right? Because what's happening in the enterprise right now? What are people are being measured on just AI progress. And so some of the KPIs people are using for that are things that are like kind of strange, right? Like token spend. Well, if you think about a marketing department, you ran marketing and you go to the CEO and say, I'm just going to spend another $100 million this year. And they would say, well, and what are we going to get for it? That would be the question, right? That question is not really being asked yet.
Yeah.
But eventually, because of the scale of that spend, companies are going to need to get productivity. There's going to be more optimization around that spend.
But in the near term, it just feels so clear to me that the technology giants of the future are not going to be these FCF giants that the last set of technology giants had been in the public markets.
I mean, look, it's hard to know where all this is going to play out. But like
what stops the train then?
Generally, what stops the train is somebody missing their numbers in a really meaningful way, which causes people to have doubts about whether or not demand will continue at the same rate, which then causes capital to slow down, which then causes valuations to correct, right? I'm not going to try to predict who that would be. I don't know.
And let's call a spade from an investor perspective. That happening at this point is helpful to some degree, given where valuations have been.
Yes. That being said, if you're one of those 3 or 4 companies that's trying to go public, in the next year, it's probably not helpful.
Right. It's not the right time for this moment. Right?
But I think if you're look, the market. I think if you were to talk to, we can all rationalize the valuations that we pay because we're paying them, so we have to rationalize them. But I think if you had 5 investors around the table and you gave them growth serum, they'd all say things are expensive right now, right? But they would also say, and things are growing faster than I've ever seen, right? And they'd also say it's unclear what the long-term operating margins are for these businesses. All 3 of those are true, right? And one of the hardest things I think about our business is we count on pattern recognition, right? Everybody counts on pattern recognition to some degree, and it could be pattern recognition on what makes a good CEO. It could be pattern recognition on what makes a good business model. And we're living in this totally new world where, sure, hopefully our pattern recognition still matters, but what works the next 5 or 10 years might not rhyme with what worked in the last 5 or 10 years. And we all have to look at this thing very differently. And I'll use again my example of Jeff Horing, who's been talking about we need to be thinking about services. And 2 years ago, I'd be like, I don't really know what he means. I mean, I knew what he means, but I was like, why is that where we should focus our time? And now it's actually very logical. And now Sequoia and others have talking about that trend as well. So, I think the markets are changing at this kind of very rapid rate. And
speed of light.
And what I think the best thing that we can do as investors is continue to have high intellectual curiosity. We have to meet it with as many companies as we can. I think it's important to play with these tools ourselves, right?
Yeah.
We're all doing it. We did a hackathon 2 days ago at Insight, 60 people internally building tools to use internally. Because I think sometimes it's hard to see the power of these things until you actually play with them yourselves.
Totally.
Yeah.
Totally agree. I vibe coded my own news app the other day to just get myself into it and learn what I don't know.
Yeah.
Deven, thank you so much for joining us. We're sitting in the middle of one of the most interesting markets. Excited to do this with you again soon when the market evolves even more at the speed of light, as we've been saying.
I look forward to it. Thank you so much.
Me too. That is Deven Parekh of Insight Partners, and I'm Sonali Basak with The Bridge by iCapital.